Broadcast is now starting. All attendees are in listen-only mode.
Superb. Welcome, everyone. Thank you so much for joining us. My name is Tom Ferguson. I'm the VP of Programming with Imagine H2O. A lot of you know me usually from the back end of an email account. This is the first webinar of our 2018 Accelerator. Welcome, obviously, to all of the 2018 Accelerator companies, but also to a big selection of our applicants this year. You did an absolutely superb job. A lot of time and effort went into it. The judges were really impressed, and the selection of the 12 finalist Accelerator companies was really hard. And so we decided to invite you to this, the first webinar in our 2018 Accelerator series, really as a thank you. The rest are closed door, but we're really glad to have you involved today to hear Alaa Ismail from Early Growth Financial Services, a very experienced CFO, to talk about how to build a financial plan investors will love. I'm going to pass it over now to Amanda Young of EGFS, who will give us a little bit of an intro, and then Alaa will say his piece. I might ask a couple of questions while he's talking, but then we'll go to a few questions from me at the end, and then we'll open to questions from the floor. So Amanda, go for it.
Hi everyone, my name is Amanda Young and I'm your moderator from the Early Growth team. I just wanted to give you all a few quick notes before we get started today. The webinar will last about an hour with time for Q&A at the end, but we'll also take questions as we go throughout. So if you have a question, go ahead and type it into the questions on the control panel, and I'll go ahead and jump in anytime I see a good stopping point so we can ask questions as we go through. Another note is that this webinar is going to be recorded and sent to all the registrants within 48 hours. And you can also find this recording and all of our other recordings of every webinar we've done on our YouTube channel, which is just Early Growth. So first of all, I'd like to just tell everybody a little bit about Early Growth. This is a quote from our founder, David Ehrenberg, and just a couple companies that we've worked with. Early Growth is an outsourced financial and accounting firm. We work with early stage companies, helping them with everything from their day-to-day accounting to financial forecasts to taxes and valuations. So now I'd like to intro all of you over to Alaa Ismail, one of our awesome CFOs, who's going to tell us a little bit more about financial planning and can introduce himself as well.
Good morning, all. My name is Alaa Ismail. I'm one of the CFO and principals at Early Growth Financial Service. I've been with them for a little over 7 years. I've had the fortune of working with a few companies in your program in the past, so I'm very excited to give this presentation today. Just a little bit more about what we do. As Amanda stated, we do accounting services. Those are essentially the blocking and tackling, the day-to-day accounts payable, accounts receivable, payroll, etc. We also provide CFO consulting, and in a full service engagement with us, you'll have a CFO dedicated to your account that you could consult with, and will be helping in the process as you grow. And almost all our CFOs are very knowledgeable in the various growth stages of early stage companies. We do taxes, we do state and local taxes. We also do federal tax returns. We also help with valuations, and as many might know that if you have a stock option plan, it's a requirement now to have valuations in order for you to price your stock options. So we help with those valuations that are typically referred to as 409A valuations. And we also work with venture companies, but that's not really applicable here. In summary, we currently serve about 1 in 4 privately funded and venture-backed companies in the United States, with offices in New York, Chicago, Seattle, Los Angeles, and of course the San Francisco Bay Area. So, the point today is really to go over the financial aspects of a pitch deck that you might give to prospective investors. I understand that a lot of you have a lot of experience here, but we will go to some basics, but we'll skim over that and get try to get into a little bit more of the details in order to address maybe your more pertinent questions. But this is a famous quote by Guy Kawasaki. So in your financial presentation, you basically want to reinforce the overall story that you're telling your prospective investors in a numerical framework. So as you're going through and you have the typical, pitch elements like your product, your secret sauce, your team, all the different elements of a successful pitch, a key part of it is the financial because it really frames your picture a little bit better and gets to the nitty-gritty of the purpose, which is to raise money. And the financial plan really complements and reinforces your vision and it essentially frames your overall pitch. So, in your financial presentation or in your pitch to prospective investors, you want to focus on three general areas. You want to have your key objectives. What are you trying to do in your presentation? You want to really focus on milestones. From a financial point of view, you want to basically look at what it is that you're trying to do in this fundraising and look at those milestones and what you need to raise for these milestones. It's okay to kind of present the overall plan and the long-term vision of your company. However, really the major milestones that you'll need to reach to your funding objective. And in order to do all of this, you're going to have to get buy-in from your leadership team. That might be just you in some cases, or it could be key partners and key consultants that are outside your company that you value their judgment and their opinion and their input. But make sure that this process is not done in a bubble where a CEO or a founder is kind of doing that the presentation on their own. Make sure that all the stakeholders have agreement. One of the things that you'll need to kind of start is to kind of start looking at your enterprise by department. By department, I mean operating areas such as sales, marketing, engineering, operations, and G&A items like human resources and recruiting and facilities and so on. So once you kind of departmentalize your objectives and milestones, so you will basically then go through with each department and then look at the different spending buckets that are typically in a financial forecast. Staffing, that's the first and probably the most expensive item. The idea here is to say, okay, reaching my milestone in a bottom-up forecast, well, who do I need to hire? And we'll go over the differences between a bottom-up and a top-down forecast later on. But who do I need to hire? What are the market rates for those folks? And start jotting that down to as you kind of outline your financial presentation. Another key thing to look at is, especially in early stage companies, professional services are a key element of your operating plan. As you go out and get consultants for certain development items or lawyers or accountants. So outlining your professional service needs is key. And then other things like that a lot of folks don't pay attention to, like travel, that needs to be incorporated into your plan. And of course, sales and marketing is usually the other really big item in a department forecast. The other item that you should focus on very early on is your revenue path. The first point when we say don't assume growth percentages, with a really poor financial plan for investors goes something like this. The size of the market is $10 billion. We hope to address X% of that, and we anticipate growth rates of Y%. Those kind of forecasts don't hold a lot of credibility, and a lot of times investors will kind of assume that that there's not a lot of thought behind the revenue growth or the revenue path for the company. So really understand the drivers that are going to help you get to revenue, whether it's in the current year or in future years, and outline that in your presentation. Figure out how you're going to get your revenue. Are you a SaaS model that is basically purely driven by hits on a website, or do you need a direct sales force team? And if you do, what kind of folks are you going to need to hire? And at what time will you hire those people? So those are the general drivers in your revenue forecast. Next. Of course, all of this needs to be done in a spreadsheet. Excel is the tool that most people use. So when I create a forecast with any of my clients, I start with actually the last point, is the key assumptions. Figure out what your assumptions are for year 1, year 2, and year 3, and then start from there and build on that. I then typically separate the worksheet into those departmental areas that I just mentioned. So engineering, operations, sales, marketing, and G&A, and jot down some of the key expense items. The first one, as we mentioned before, is the labor component. And I like to do that by department because it focuses your thought in that particular area or function of your operations. Who you need to hire, what the salaries are, at what point will you hire them. I typically do that by department, and then figure out what are the other key expense drivers. Consulting is in the marketing area, events that you might want to go to, and start kind of jotting down the key expense items. And once you have those, then schedule them out. We'll go again into a bottom-up and a top-down approach, but for year 1, it should be bottom-up. So it should be fairly detailed. So for hiring, start with what month these people will be hired. For consultants, what month will you engage the consultant? And schedule that out in your spreadsheet. And then the other big area, of course, is revenue. So we'll get into that again, the top-down and bottom-up approaches. But for your near term, if you do have a revenue, to the extent that you could tie it into a pipeline, all the better. Meaning, here are the customers that we've engaged thus far. This is the potential size of the deals. Here's the probability of closing the deal and the related timing. So once you spreadsheet all of that out, you could then put it together in a good profit and loss statement, and at least have those fundamental drivers that you could present. The next slide, please. So you'll be working with your key assumption worksheet that will drive a lot of these, and it will have, if you are not doing a bottom-up forecast, you'll probably want to include some of the fundamental assumptions that you're here. For example, if you are having a hiring plan based on a rate as opposed to individuals, you want to put that down in your key assumptions so the reader will know. If you are using a top-down approach for your revenue, where you're, for example, using a market size or a revenue per sales team or salesperson, you want to put that in your assumptions. If you're a SaaS company, you want to put things like a churn rate or the lifetime value of that customer. How long do you anticipate having that customer? Are the contracts 1, 2, or 3-year contracts? So those are the key kind of assumptions that you'd want the reader to know upfront. Next slide, please. So once you have all that down, you basically then could start your financial planning and budgeting process. The underlying thing that I would like to kind of off this screen is to try to get somebody who's familiar with financial presentation, somebody who has expertise in that, so your financial plan makes sense. A lot of times, the best presentations really follow the standard financial, the financial statement presentations. By that I mean profit and loss, balance sheet, and statement of cash flow. A lot of times, the area that gets a lot of founders who don't have an accounting background, and especially in a more complex model like a SaaS model, is their balance sheet assumptions and their cash assumptions. And getting that outside help will really make your presentation pop and make a lot more sense, because remember, the majority of the folks that you're presenting to in a investing scenario or presentation are familiar with all of this, and will make you look a lot better if you have a professional financial statement presentation. It doesn't have to be in a detailed format, but at least the elements kind of bind together, and that the presentation makes sense. So once you start that, you're going to use your revenue assumptions, and you're going to schedule out your revenue forecast. You would like to run different scenarios. So prior to your presentations, again, working with your team to figure out, what scenario makes the most sense and what is the most defensible as a team. And by running these different scenarios and using different assumptions, you'll be able to fine-tune your presentation a lot more, and again, have a lot more credibility. I think I mentioned before, you want to forecast on a 3-year basis. A lot of investors like to see that. It's not that they're going to hold you accountable for year 2 and year 3 to the letter, but a lot of times 3-year forecasts kind of show a trend and give a better overall picture to a potential investor. So I typically like to use year 1 and do a bottom-up forecast, and then year 2 and 3 do it on a top-down basis.
Alaa, just a quick question there. Is that okay?
Sure.
It's just a so the 3-year plan. I think it's an interesting one. You said they won't hold you accountable for kind of years 2 and 3. In your experience, to what extent are entrepreneurs held to account for their financial plans by investors, and within what time frame? So really, the question is kind of what's at stake for getting this wrong, being optimistic or sometimes pessimistic.
Right. So, venture-backed companies or venture investors understand that the reason why they're investing in these companies is that they're nimble and they react to changing conditions. So the budgeting exercise is definitely important. But once you get your funding, if you deviate from the year 1 forecast, it's okay as long as you have credible reasons that support it. For example, the product we thought we wanted to build in 6 months ago has changed a little bit. Therefore, we need to hire these types of people, or we don't need to hire these types of people, or our market penetration has been so much better than we had anticipated. We need to increase our spend rate. So being nimble is a key benefit to you as a startup, and a lot of these venture investors expect that, and as long as you have a rational reasoning behind that, and that you're not deviating without an explanation, I think it's very much understood.
Great.
Especially in year 2 and 3. Again, if any investor out there, I haven't met a credible venture investor that really says, okay, you forecasted 2 years ago that your revenue will be X and it's significantly below X. Why is that? I think if it ever gets to that, you probably don't have a savvy investor, or you probably have not been in communication with your investor well enough that they understand how that original forecast has changed. Does that answer your question?
It certainly does. Yeah, thank you so much.
Yeah. Next slide, please. So once you've done all that, now is the time to essentially get ready for your presentation or your pitch deck. What you want to do in your financial forecast is really kind of look at milestones. A lot of times the investor is not going to want to know that you're going to be a multi-billion-dollar company in 10 years. They're more interested in where you're going to be, for what this funding round is going to achieve. So pick realistic milestones. Say a year out, we are planning to get a certain kind of traction in the marketplace, or we're going to achieve this milestone in our product development. We're going to have a prototype by September of 2018. We're going to have 5 test customers by a certain date. So based on those milestones, you're going to tie in your funding requirements, and it's also going to tie into your financial forecast. So it's going to support hiring plans. It's going to support spending assumptions. It's going to support your raise needs. So don't go into a pitch with your ultimate funding milestone. Understand that investors like to take things in smaller chunks. You may have an entity that's going to require 3 or 4 rounds of raise, or it could be an entity that requires 1 round. So understand your fundraising milestones from the very beginning will be critical. When you hopefully have done all the homework and prep that we talked about before, you're going to know how much time that you think you're going to need and the resources that you're going to need. So you're going to have that outlined in your financial presentation. And then when you have your final forecast, don't be chintzy and don't start being frugal on yourself. Give yourself a little bit of a cushion, because there's always items that come up. And it's better to be conservative and have a little bit more breathing room than to be really, really tight and then have to come back and explain, why you need, say, more funding or why expenses exceeded. It's better to beat goals than to come in and require additional funds. So give yourself a little bit of a buffer when you're fundraising. So in a budget process, you'd like to be able to put down everything that you need. But again, be realistic with your enterprise and your operation, and figure out what are the trade-offs, what are the things that you need absolutely in this funding stage of your company, and what items that you don't need. And get rid of the things that you feel may not be necessary or may not be 100% required. Separate your expenditures, and this is where a financial planning or an accountant or somebody from early growth will come in and help by separating your expenditures and your presentation by department. It'll give a much more clear picture to a prospective investor. Companies in the very early stage will have a lot more engineering or operations expenses. Companies that are more developed will have sales and marketing expenses, and those kind of trends are what investors like to see. Be realistic and figure out, based on your resources, what you can do now and what you'll be able to do later. Early stage companies may be focused on developing their product, and a sales and marketing effort is an expensive endeavor. So the goal of the presentation will say, hey, let's get our product to market, let's get it tested, let's get customers that buy into, or test customers that buy into our vision, and then we'll come in and see what's needed to really expand and hit the marketplace. So the things that you need to do now, put that emphasize that in your financial presentation. Things that will be done later, I would not put it in. Put that in your top-down forecast in years 2, 3, or beyond. So we've hit this in several different ways, but typically investors like to see a 3-year vision, and typically the first year it should be bottom up, and year 2 and 3 are top down. We've mentioned this several times, but things will change, and I think a lot of investors expect that. But the year 2 and 3 really is more for trends. For example, year 1, we're going to develop our product. Year 2, we're going to spend time manufacturing it and testing the market. And then year 3, we're going to go out and spend a bunch of money on sales and marketing to start selling it. That kind of trend is visible in a 3-year forecast. And that kind of thinking is what investors really like to see. The other part of it that is typically you need probably outside help is the cash flow assumptions, especially in companies that require a lot of capital expenditure. So if you're creating a product and you're spending a lot of money on materials and inventory, and you need to figure out the different cash flow and how that relates to a P&L. So burn rates are really important. I like to actually present a slide that just shows, or a graph that shows the burn rate in my forecast. And don't be afraid to say that, in year 2 or halfway through year 2, I'm going to need to raise more money. I think investors, especially in the Valley here, and savvy venture capital investors, want to see that thinking up front, and they expect that. So include in your forecast some kind of a burn rate or cash needs slide. Next slide, please. We mentioned the reason why you need to basically create this financial picture. Part of it is also you're kind of analyzing your business. You're informing the investor of what kind of trends that you're seeing. You want to, if you've a mature company, you want to tell, and you've had a couple of years of operations or a year or 2 of operations, you want to tell a story of where you've been, so you could essentially tee up where you're going. And you want to also inform the investor of what are the changes that are going to happen either in your business or in the industry, and make sure you highlight that in your financial presentation.
Alaa, if you don't mind, we have a quick question from Bernice.
Okay.
He was just wondering if we're looking at bottom up from year 1 to 2, and then looking at top down forecasting from year 2 to 3, and if it tends to be year 1 is developing and year 2 is testing.
Yeah, so I think we're going to get that in the future slides, but yeah, typically in year 1, you'd want, or the 1 year depending on where you are in your operations, year one could be the first year of operations, or it could be the year 2, 3, or 4 of your business. But the year one forecast that you're creating for an investor should be bottom up. And then year 2 and 3 is more the trending, or where you think the business is going to go, and it is top down. So things like spending rates for year 2 and 3 could be more formula driven, but in year one it should be, and investors will expect to see it top down. And we'll get into the differences in another couple of slides. So the top-down financial projection, and I'll kind of go down a typical P&L and explain the difference between a top-down and a bottom-up projection. In a bottom-up revenue projection, for example, you want to be able to identify customers or potential customers, or sales targets per direct sales leads, or if you're a SaaS company, a formula on how you are calculating your revenue. Essentially, it's a detailed workup of how you're estimating your revenue for that year, for the first year of operation, and that's the bottom-up revenue projection. Top-down revenue projection for, say, year 2 or 3 could be as simple as we anticipate to grow our sales and marketing effort by X%, therefore our revenue is expected to grow at this rate. Or if you're a SaaS company, for example, we're expecting churn rates of X and growth rates or customer renewal rates of Y. And the top down for the revenue will be more formula driven or more trend oriented. On the financial part of it, the bottom up will be headcount analysis. We need to hire these folks at this salary in these departments, would be the bottom up approach. Top down approach would be we need to expand by the sales and marketing by 10 folks to meet our revenue plans. And you don't need to kind of get into the nitty gritty hiring detail for years 2 and 3. And so on. You would kind of go through your assumptions where year one in the bottom up, you're essentially taking and looking at your detailed needs. But for years 2 and 3, you could just do it in a kind of a reasonable trend or growth based on where you think your business is going to be. So I think we've mentioned before, typically investors want to see 3-year analysis. So both methodologies are really required when you're undergoing this task. Bottom up for the near term, top down for future years.
One more quick question. Ari would like to know, how does Alaa suggest taking into account a long CAC, for example, in agriculture, that's depending on the type of agricultural is not just cultural, but based on the plant cycle as well?
Wow. That's a great question. I hope I could. I'm not sure the specific industry, so I'm not going to pretend I know exactly how to address that one. But any kind of long-term variable assumption, if you could state that up front and kind of talk through that when you are presenting your revenue plan, and let the investor know how you are assuming these variables that may arise in the future. I think that is probably the best way to approach it. And then in your forecast, you're just going to have to make an assumption. You're going to have to say, okay, this is what we're using in our forecast. And if there's a challenge to that, just be prepared to talk about it. And again, working with a team and industry experts, you'll be able to kind of forecast that in the best light possible. And I think in a lot of times, and especially for those who have been through a fundraising process, know that just by presenting numbers, people don't take what you're saying as without being challenged. So be prepared for those challenges and be prepared to answer the questions that may arise for your forecast assumptions. So I'm not sure if I answered your question well, but I hope that this is helpful a little bit. Okay. So let's go back to the bottom-up financial projections. So you want to project your revenue growth over the next 1 to 3 years, but have the revenue forecast for year one be as detailed as you can. So if there's a pipeline, if you're a mature entity and you have an existing pipeline of customers, for example, put that down. Put it down that, here are the customers that are in our pipeline, here are the percentages that we think of them closing. That kind of thought is super valuable in a bottom-up forecast. To the extent that your revenue is driven by sales teams, then let that calculation be known somewhere in your presentation, so that at least in the first year of operation, that revenue is well supported. That revenue number that you're putting in there is well supported. The spending. So look at the buckets that we just mentioned before, and do the detailed spending for year one in the bottom up. Look at if you need facility, your rent, your professional services that you're going to need, legal, accounting, so on, and schedule those out in great detail and in the months that you anticipate those expenses to occur. And then finally, head count. Schedule that out by specific hires that you need, and try to break that down by departments. And if need, you don't have to do this in your presentation, but have that the related salaries supported as well. That you don't have to present that, but at least have that kind of detail in your workup. And then finally, the bottom-up financial plan should be tied to whatever kind of milestones in your funding plan as well. So it could be that in year one, you don't plan to really start doing the sales and marketing towards the latter half of the year. Just make sure that you highlight that in your bottom-up forecast, that the reason why sales and marketing is increasing, say, at the second half of the year is that we don't plan to go to market until later on in the year, and that's what we're tying these specific milestones to our bottom-up forecast. A top-down, on the revenue side, we've talked about it before, is a lot more general. You may want to start with the market size, or if you've built up a year one revenue forecast, you want to be able to expand on that with growth rate assumptions. You might want to identify different market segments that you'll be addressing in year two and year three for your top-down projection. And then extrapolate the different expense and revenue items by tying that into your general assumptions for your top-down projections. So, for expense and headcount, for example, you could say, we will need to grow our engineering team by X percentage, and therefore our engineering expenses will grow in year two and year three by these percentages. So a top-down, if we haven't kind of gone over this at nausea here, is more formula-driven and is kind of like a 5-mile view of the forest here. So I'm hoping that I addressed kind of the general questions, but or the general issues here in formulating a good financial plan that investors will love. But I'm happy to address any questions, detailed questions that you might have.
Fantastic, Anna. That's really, really helpful. I've got a few, and then Amanda, we can go out to the floor as well. Just let me know when others come in. So the first thing I wanted to ask you about was assumptions. Okay, so we're building a plan into the future, and there are ones where assumptions are key. Hopefully, certainly for companies that have a little bit of traction, you've got something like a starting point, or at least a view into what your sales pipeline might be with early LOIs or whatever it can be. But in terms of kind of key assumptions, so for example, as a revenue driver, sales per hire on the sales team. So as you add more headcount into the sales team, you're anticipating kind of growth against those hires, or even your initial revenue projections. In your experience, like, what are the determinants of getting those early assumptions or even later stage assumptions right? Where is it that entrepreneurs can look to find examples of kind of good thinking?
Yeah, so the number one is if you're in a mature industry, or if there's other companies out there that you might be familiar with, or if you've talked to potential customers, those kind of data points are really, really critical in evaluating or supporting your assumptions.
Mm-hmm.
If you're a groundbreaking enterprise and there are really no comparisons out there, but you believe that there's a real need, that kind of support is really difficult, and it's hard to kind of you're going to have to kind of make the leap in those instances. But absent that, I would try to talk to as many folks or experts that are familiar with your industry, and talk to them about your underlying assumptions. I'm saying this if you don't really have any kind of a history, or if you don't have a customer input or anything like that. But talk to people in your industry, and get as much support as possible, so that when you give your assumptions, that it's at least based on industry information, or based on generally the same information that your investor will probably have.
Right.
So that kind of thinking is appreciated by an investor.
Okay. And I was really interested in this idea of kind of margin of safety. Obviously, as useful to the entrepreneur as it is to the investor. But it seems to me that there is the dynamics, especially in investor conversations, is that the nature of negotiations is that you erode the margin of the safety as people push you for harsher and harsher milestones against the amount of money that they want to give you, because that means that the valuation is going to be higher at the next kind of fundraise. I just wondered whether you could make any observations on achieving that margin of safety post negotiation with an investor.
So the investor negotiations that I have seen very, very rarely evolve around the need for your funding, meaning that they don't go in and say, wait a minute, I'm going to invest $1 million only if you reduce your expenses by X. Typically, right. There's a general discussion about your plan. Very few investors will get into the nitty-gritty detail of your specifics. Like they're not going to say you need to hire this engineer at 120 as opposed to 130. So those kind of discussions rarely happen with investors. However, valuation discussions do occur.
Yes.
And they are supported by your, whether it's your, most of the time it's your revenue potential, but a lot of the time it's really gauged on similar valuation of other companies or other companies in your industry. By putting a cushion in, is that don't kind of forecast your plan in a bare bones type situation, and therefore get into a valuation discussion, raising an amount of money that is just not is gonna limit you operationally. So separate the valuation discussions from what you need operationally, and that's where the cushion should be, and then be as aggressive as possible in your fundraise valuation, so you could figure out get the money that you need at the best possible valuation, because the two very often are not directly related, meaning that the valuation discussion doesn't evolve around what your consulting expenses are.
Yeah. Oh yeah, that's really helpful. And related to what you just said, in terms of the raise, this is slightly moving on and following the logic of what you said, rather than necessarily just the projections. In terms of the raise and selecting amounts, are you in the camp of get what you can now, or get what you need to get yourself to a specific milestone and then raise again, hopefully at a valuation? Where do you sit?
That's an excellent question. The answer is it depends. So the ideal the ideal scenario is to gauge your raises based on milestones, because you get the best valuation then. If you're developing a product, when you get a prototype, then your next valuation is for the sales and marketing effort, and so on. As you progress in the company, your company is becoming more and more valuable, and therefore you're going to get better valuation, and you're going to dilute yourself less. However, so that's the ideal in a situation. The other piece of it has to be an evaluation of where we are in the investing landscape. If you're feeling that investors are getting tired, and consultation with the investment world and folks in the industry will kind of give you that guidance. But if you feel like there's a lot of companies out there asking for money, that this is your best shot, then my counsel would be to go in and get as much as you can at this stage at the best valuation possible, because you don't know if you're going to be able to raise money for stage 2, stage 3 of your company growth. So it's a fine balance, and I know it's not a perfect answer, but there's really you need to kind of feel it out, and a little bit of gut check. Figure out where you are and how confident you are in your vision, and how much dilution you're willing to take for that gamble. And at the end of the day, if you're in this space, you're a risk taker, and if you're going to bet on your achievement, then my guidance would be to wait till the next milestone to do your raise. If you're successful and if you're in a hot area, you should be able to raise the money, especially in the valley. However, if things are a little bit more tight, and you're willing to take the dilution, and you're thinking that if you're successful, the gain in value is going to be so much that you're not going to worry about it, then get as much money as you can.
Yeah, sure. Okay, that's really helpful. I'm going to go from sort of the macro to a couple of things on the micro side of this. So, scenarios, running different scenarios. What should people be thinking about in terms of running those scenarios? Is it just a high, medium, low, or should people be doing matrices of many different options to try and kind of optimize exactly where they want to be? Just the mechanics of that scenario analysis. Anything that you would say now?
Right. So if you're in a development stage of a company, you'd want to kind of evaluate the scenarios based on the milestones. So for example, you might want to take a scenario that has a high hiring plan, where you're hiring folks, engineers and developers very early on, to get get to the marketplace sooner, and that is going to give you some kind of an advantage. So that type of kind of internal evaluation into in the different scenarios will help guide your milestones that you're presenting to the fund, to whoever is investing in your company. So so those kind of scenarios will help support the milestone objective that you're presenting to the investor. And having that in the back of your mind in case the question comes up. For example, I've seen this happen. So you're going to hire 10 engineers. What if you hire 20? How's that going to look? And how much more money are you going to need? You only have 2 salespeople. What if you hire 5 salespeople? Those kind of scenario assumptions are not only good for you to figure out what the best scenario for your presentation is going to be, but also helps you understand your business better and helps you be able to be a lot more informed in a discussion. Remember, this presentation that you're giving is going to be a very minor part. The most important part is going to be the discussion that the presentation brings up, and the impression that the investor has on you and how well you're prepared to answer those questions. Because a lot of the number one question I get from a potential investor if I'm showing them a pitch deck is about the team. Are they rock stars? Have they done it before? So your main goal here is to be able to instill that sense of confidence that you know what you're doing. And a scenario evaluation helps you in figuring out exactly what you're presenting and helps you in addressing potential questions.
That's really helpful. So to that end, going on to just the team thing quickly, is that how early should an entrepreneur be looking at bringing kind of a financially literate person onto the team? Now, I understand that this question is exactly the kind of the core propeller of early growth kind of pain point in the market and essential kind of value proposition. But how would you think about that if you were starting your own company?
I would hire early growth as quickly. No, that's self-serving. No, we actually have talked a lot about that, and I think anytime that you get a outside funding I'm just going to pick a number here of $500,000 or more, I think you need some kind of outside counsel. I think to the extent that you have more than 3 employees, you'll need outside financial help. I think especially if you have a venture investor or an institutional investor of any kind, regardless, you need outside help. Those are the typical milestones. If you're just very early on and you're bootstrapping it, for example, there is guidance that we give. You don't necessarily need to hire a professional to maintain your accounting, but open up a separate bank account for your company. You don't intermingle your personal expenses with your business expenses. Hire somebody, pay attention to your taxes and your regulatory filing requirements, and don't let those slip. Things like payroll taxes are never worth doing on your own. I get a payroll service. There are kind of underlying things for smaller companies that you do not necessarily need a full-time or even of a part-time accounting firm to help. But if you have any kind of outside investment of any size greater than, say, $500,000, you definitely need outside help.
Okay, that's very helpful. Really, excellent. So just one really quick one. there's a lot of detail here, right? And if you talk about the kind of Kawasaki model, there's one slide that is reserved for kind of financial projections. So when and where is this information being shown to investors? Should it be a separate conversation with a separate slide deck?
Absolutely. So the financial presentation will be very summarized, and by it being summarized does not mean that there's not thought that goes into it, because a lot of these investors, especially if they're institutional investors, are very savvy. So they're going to be able to look at your financial slide and pick out problems with it. If you're a SaaS model and you don't have the proper GAAP revenue recognition, they're going to pick that out. But having all the support ready in case the investor wants to dig into it at a later point is really, really important. And again, if you're doing it properly, all that support should be there. And if the question arises, just feel free to say, I'm happy to address that offline. We have all the documents, we have all the assumptions, we have the support for this, and then do that offline.
Okay, that's really helpful. And
an institutional investor will, the guy may be sitting, or a person sitting in the room may not be the right person, but they might have somebody in their enterprise that will go through that detail with you.
Yeah, absolutely. And so the last one from me is that, you've obviously worked with a lot of early stage companies before. What are the big mistakes people make? Maybe just one or two of those. And then what is the one thing that, you think helps them most, whether it's mindset, specific tactics, like, whatever those might be?
The number one mistake is that I see is that enterprise or entrepreneurs tend to gauge their success by the amount of money they raise. I just basically warn folks against that. I've seen so many companies get very, very hefty amounts of money that are raised, and the execution wasn't there. And I've seen companies get shut down shortly after, by shortly meaning a few months or a year after their raise. So don't kid yourself by saying I'm successful because I raised $10 million. Keep your eye on really the goal of the enterprise and make sure that you're achieving those goals, and that at the end of the day, you're running a business. So tying that, your business operation, and making sure that it's a successful business enterprise and that the funding is just the means to get to whatever operational goal that you have is going to serve you really, really well. Number two is, once the company raises money, there's a general tendency to spend it. and that's really what it's meant for. I'm not trying to be glib about that. I mean, you should spend it in a very, very intelligent way, but make sure that it's not all spent in the first 6 months and then you're coming back without achieving the operational goals. So having that forecast and updating it on a regular basis, and making sure that your cash burn is in line with what your expectations are and how your operations are going. That is so critical, because I've seen so many companies, raise a good chunk of money, and then come a year, 2 years later, and having to need more funding and have not met their goals, and then have to take either significant dilution or regrettably shut down operations.
Right, absolutely. All right, I think that takes us to 11 o'clock. Amanda, do you want to close us out? Alaa, thank you so much. That was a great session.
Questions from people, if you don't mind answering them really quick, Alaa.
No problem.
Sorry, I didn't want to jump in. There's just three. Bernice wanted to know how you calculate customer acquisition costs when you are pre-launch.
Oh, that's you have to essentially take the customer acquisition cost, the type formula, and to the extent that a lot of the information is not there, you have to go back and do some general assumptions. And in this case, investors are not going to expect that number to be spot on. You know, if you're say a SaaS company, it's going to be very, very difficult because you don't have the online marketing presence to figure out hit rates and things like that. If you're a product company, you don't know, you know, the number of successful customers per engagement. So CAC is really, really hard in the beginning stages, but it doesn't mean that you don't do it, but you just have to use assumptions for the information that you don't have. And really, you know, a lot of the investors are not going to expect that number to be spot on, but we'll expect that there's reasonable thought behind it. Next question.
Yeah, so any advice on how to stage 2 successive rounds? Like, should you do the first one not too big and the second one bigger, or do you have, or the other way around?
It all depends really what the operational requirements are of the companies. Typically, the funding in stages is growing, so where Series seed is smaller than A and B and so on. But typically the milestones that are associated with those raises is seed is to get the idea to fruition, B is to get the product to market. I mean, A is to start working on the product, B is to get the product to market, and Series C is to basically take the business model and get it to the growth stage of the company. So the expectations is a growing, and you kind of want that for your enterprise as well, because the more money you raise early on, the harder it is. The valuation and the dilution becomes really, really critical. And I assume that that's why we get into this business, is that we want to be able to maintain a growing valuation for the company, and that the value of the company is going to grow over time.
Great, thank you. So the last one is, can you recommend a good financial model template for a SaaS product or company?
For a SaaS, you know what, there isn't.
I don't know how you say that.
There really isn't a model, say, on the internet that I know I have my own models for the different industries, and I know it's unfortunately it's not something that I've been able to find online or in any kind of resource out there that says, okay, this is a good model to use. You know, I know that Imagine H2O has these resources available, but just briefly talking to a financial consultant or somebody like myself, and that might help you generate the model. But right now, I'm not aware of anything short of what I create or what a colleague creates.
Right. So basically, you need a financial person to help you with that.
I think so.
Great. Okay, well, thank you. And if we missed any questions, we are going to send a follow-up email with the deck and with the YouTube video and with everybody's contact information. So feel free to reach out with more questions, and we can pass those along to Alaa. Thank you, everybody, for joining. Thank you, Tom and Imagine H2O, for having us. This was awesome. And I hope
Thank you.
Yeah, have a good rest of your day, everyone.
Thanks, Amanda. Thanks, Alaa. And thanks, everyone, for joining us. All the best.
Thanks.